Hey everybody, Matt Graham, MBS Live here with you on Wednesday, April 8th, 2020. We're going to keep this video short today because I'm recording content for the big change over to the new platform that I've been talking about in chat. That's going to be awesome. More on that soon. As far as today goes, pretty similar to yesterday in the sense that MBS did really well and Treasuries ultimately closed at higher yields than they did in the previous session. This MBS outperformance has to do with a couple things. First off, we have the Fed buying a ton of MBS. Supply is getting a little bit smaller, and they're trying to keep prices, it would seem, in a narrow range or as narrow a range as possible, something that a lot of market participants appreciate. And then Treasuries have had their own set of concerns, mainly due to supply. Treasury auction supply is one part of that. Anticipated additional supply in the future due to fiscal needs is another part, and then corporate bond issuance is yet another part. You can look at the primer on that by typing issuance into the help menu. Long story short, the corporate bond issuance process can create some front-loaded selling pressure that ultimately resolves itself if hedges are bought back. Yes, that's going to sound confusing if you haven't looked into it, but again, check out that help menu link if it is confusing. From a lock float standpoint, for the mortgage market, it continues to be an environment that doesn't operate by the rules that are in play 99.9% of the time, looking back through MBS and mortgage market history. And that has to do with the temporary factors and considerations that are causing headaches for a lot of the mortgage market. Servicing valuations are a big part of that. Lender capacity is a big part of that, not just in terms of personnel, but more so in terms of access to funding. And lenders are repricing in the middle of the day, depending on the lender, of course, in ways and by amounts that don't necessarily line up with MBS. Big moves in MBS still will generate reprice risk or reprice potential, but there are going to be plenty of reprices that don't adhere to those cues. So when it comes to deciding whether to lock or float, I'm still in favor of taking what look to be good opportunities, high percentage shots. If you see a lender that's had kind of bad pricing, suddenly improve pricing significantly, and that pricing is way better than other lenders that you have access to, it's a compelling argument in favor of locking. But the environment, at least as far as conventional 30-year fixed stuff is concerned, and maybe to some extent government loans too, is getting a little bit more friendly for the risk takers out there because we are not seeing an acceleration in the melting down of the mortgage market right now. QM and jumbo was sort of a big deal. It has already happened for many lenders and will continue to happen for others. But in those cases, that pricing has largely already taken a hit. And we're never really talking about non-QM and jumbo stuff when we're talking about locking floating anyway. It's mostly a reference to what's happening in 30-year fixed space and generally for conforming loan amounts. As I'm sure you've seen, high balance stuff took a pretty bad hit, and that also hasn't been playing by the rules. All that to say that if we are looking where we normally look, things are getting a little bit more stable and have been flat, friendly, predictable enough in the MBS space and more importantly, flat and friendly enough in lender pricing space to think about taking risks again with clients that are interested in taking the risks and understand them. If the program is off the beaten path in any significant way, from a credit box standpoint, there is less of an argument to be made for taking those risks. Real quick housekeeping note before we go, check out this article at the top of the news stream about the mortgage industry having questions and concerns that addresses, questions and concerns that are relevant. It also provides a little bit of a recap about some of the stuff that has been causing drama for loan pricing, and just another take for you to share with your clients and partners if they don't necessarily understand what's going on, or something for you to read if you don't necessarily have a full grasp of what's going on. Not to say I do, but there's my thoughts anyway, or there are my thoughts anyway. And, throw some comments at the bottom if you want to add to the discussion. Always appreciated. Keep in mind, tomorrow's the last day of the week for bond markets due to Good Friday. So, it could be a situation where we have some trade flows move in a direction simply because traders are closing positions ahead of a 3-day weekend. But we'll cross that bridge when we come to it. That's going to do it for today. Back with you guys tomorrow. Have a great rest of your day.